we need to talk. For the last few weeks, we have been obsessed with silver. We have watched the vaults drain, the mint close, and the price go vertical, and rightly so. The silver squeeze is the most exciting story in finance right now. But while we were watching the precious metals market, something broke in the bond market. Something so massive, so structural, and so terrifying that it makes the silver squeeze look like a rounding error. If silver is the canary in the coal mine, the Japanese bond market is the atomic bomb sitting at the bottom of the mine shaft. And the timer just hit 0. We are looking at market indicators that point toward a significant structural shift. The yields on Japanese government bonds, JGBs, are soaring to levels we have not seen in decades. The 10-year yield has hit 2.34%. The 20-year yield is at 3.47%. The 30-year yield is at 3.90%. And the 40-year yield has crossed the 4% barrier to hit 4.23%. Now, if you live in the United States, you might look at those numbers and say, so what? U.S. rates are higher than that. But you have to understand the context. For 30 years, Japan has been the land of zero interest rates. For 30 years, the Bank of Japan has pinned these rates to the floor to keep their zombie economy alive. In Japan, a 10-year yield of 2.34% is not just high. It is an economic heart attack. It means the cost of servicing their massive national debt has just tripled or quadrupled overnight. So why does this matter to you? Why should a guy in Texas or a family in London care about the yield on a Japanese bond? Because Japan is the global creditor. They are the rich uncle of the world economy. For decades, Japanese investors have taken their savings, which earned 0% at home, and sent them overseas. They bought U.S. treasuries. They bought European bonds. They bought U.S. tech stocks. Japan owns over $1 trillion of United States government debt. They own hundreds of billions of dollars in U.S. equities. But now, the dynamic has flipped. With yields at home soaring to 4%, the Japanese investor no longer needs to send their money abroad to get a return. The market is being pulled toward these 4% yields in Tokyo in their own currency, without worrying about exchange rates. This creates a giant sucking sound. It is the sound of trillions of dollars of liquidity being sucked out of the global markets and rushing back into Japan. We call this the Great Repatriation. And it is the trigger for a global margin call. Think of the global financial system as a giant leverage trade. For years, hedge funds and banks have borrowed money in yen because it was free, and used that money to buy Nvidia, to buy Bitcoin, to buy real estate. This is the famous carry trade. But now, the yen is getting expensive. The cost of borrowing has skyrocketed. So what do the traders have to do? They have to pay back the loan, and to pay back the loan, they have to sell the asset. They have to sell the Nvidia. They have to sell the Bitcoin. They have to sell the real estate. The spike in Japanese yields is the pin that pops the everything bubble. We are already seeing the tremors. The volatility in the U.S. stock market this week is not random. It is the early stages of this unwind. The data we are analyzing suggests a clear pattern. If the global system were functioning normally, we simply wouldn't be seeing these yields. Trust me, things are not normal. We are looking at a sovereign debt crisis in the world's third largest economy. Japan has a debt-to-GDP ratio of roughly 260%. That is the highest in the developed world. When you have that much debt, you cannot afford higher interest rates. Every 1% rise in rates consumes a massive chunk of the national budget. At 4%, the interest payments alone could consume the entire tax revenue of the Japanese government. This means the Japanese government is facing a fiscal crisis where servicing their debt could potentially outpace their tax revenue. So why are they letting rates rise? Because they have no choice. Their currency, the yen, was collapsing. To save the currency, they had to stop printing money to buy bonds. When they stopped buying bonds, the price crashed and the yield soared. They had to choose between saving the bond market or saving the currency. They chose the currency. And in doing so, they just blew up the global cost of capital. This is a systemic event. When Japan sneezes, the world catches a cold. But Japan isn't sneezing. Japan is having a seizure. The immediate threat to your portfolio is not the Japanese economy itself. It is what the Japanese institutions are about to do to your economy. There is growing speculation among market analysts that we could see major Japanese pension funds and insurers begin to trim their U.S. holdings in the very near future. They are sitting on approximately $500 billion of U.S. stocks. Why are they selling? Because they need the cash to cover their losses at home. When the value of their Japanese bond portfolio crashes, remember, when yields go up, bond prices go down, they have a hole in their balance sheet. To fill that hole, they have to liquidate their profitable positions, and their winning tickets are U.S. tech stocks. This is why we warn about a slow grind downwards. The data says they won't dump it all at once. That would be too catastrophic. Instead, they will sell slowly, methodically, day after day for the next 12 to 24 months. This creates a permanent headwind for the stock market. Every time the S&P 500 tries to rally, a Japanese pension fund will step in and hit the sell button. It is like trying to swim upstream against a relentless current. This is why the analyst in the data warns, the world is entering a rate environment no one alive has traded before. We have never seen a world where Japan is a net seller of global assets. For our entire investing lives, they have been a net buyer. The flow of the river has reversed, and this reversal affects everything. It affects mortgage rates in the US. It affects the price of gold. It affects the stability of the euro. But the biggest victim will be the US Treasury market. Japan is the largest foreign holder of US debt. If they stop buying, or worse, if they start selling, who replaces them? Who buys the trillions of dollars of debt that the US government issues every year? The Fed? We know that leads to inflation. China? They are selling too. Saudi Arabia? They are buying gold. The buyer of last resort is gone. This is why US yields are likely to spike alongside Japanese yields. And when US yields spike, the economy breaks. Housing breaks, auto loans break, the banks break. We are watching the dominoes fall in slow motion. The first domino was the Japanese yen. The second domino is the Japanese bond market. The third domino is the US stock market. And the final domino is the US dollar itself. Because when the dust settles and the selling stops, the only way the system survives is if the Federal Reserve prints enough money to buy everything Japan is selling. They will have to monetize the entire debt stack. This brings us back to silver. Why is silver hitting $94? Why is gold hitting $4,600? Because the smart money sees what is happening in Japan. They know that the only solution to a sovereign debt crisis is currency debasement. They are not buying silver just because they like solar panels. They are buying silver because they are fleeing the bond market. They are running away from the widowmaker trade. Japan is the canary. The explosion has happened. The shockwave is traveling across the ocean. In the next part of this deep dive, we are going to look at the repatriation event. We are going to analyze the specific assets that are at risk. We will look at the $500 billion figure in more detail. Which stocks do they own? Which sectors will be hit the hardest? And we are going to explain why this selling pressure is unlike anything we have seen before because it is involuntary. They are not selling because they want to. They are selling because they have to. The global margin call is here. The phone is ringing. And Japan is on the line. Are you prepared for what happens when they hang up? We established that Japanese yields are spiking. The 40-year bond is yielding over 4%. This has effectively ended the era of free money in Japan. But now we have to look at the second-order effects. We have to look at the flow of capital. For the last 20 years, Japan has been the world's piggy bank. Because they couldn't get a return on their money at home, Japanese institutions, pension funds, insurance companies, and banks sent their money abroad. They became the largest foreign holders of United States assets. But now that the dynamic is flipped, now that they can get a 4% return at home, that money is coming back. We have reports indicating that Japanese institutions are preparing to offload approximately $500 billion worth of United States equities. $500 billion. To put that number in perspective, that is roughly equivalent to the entire market capitalization of Tesla or ExxonMobil being sold into the market. But who is selling? It isn't just day traders in Tokyo, it is the whales. The biggest player in this drama is the GPIF, the Government Pension Investment Fund of Japan. It is the largest pension fund in the world. They hold trillions of dollars in assets, and a massive chunk of that is in US tech stocks. They own Apple, they own Microsoft, they own Nvidia. And when you look at your 401k statement and you feel good about your gains, you are often looking at the same stocks that the GPIF holds. You are in the same crowded trade. But here's the difference. You are holding for retirement, they are selling for survival. As the value of their domestic bond portfolio collapses due to rising yields, they face a solvency hole. Pension funds have liabilities. They have to pay retirees every month. If their safe assets, the bonds, lose value, they are forced to sell their risk assets, the stocks, to raise cash. This is not a choice. It is a mandate. It is forced selling. The data we analyzed gives us a very specific timeline for this. It says they won't dump it all at once. That would be too catastrophic. Instead, they will slowly dump it over the next few months. This is actually worse than a crash. In a flash crash, the price drops, panic ensues, and then buyers step in to pick up the pieces. It is over quickly. But a slow dump, a structured liquidation over 12 to 24 months, is a torture chamber for the stock market. It creates a permanent overhead supply. Every time the S&P 500 tries to rally, every time there's a glimmer of hope, the Japanese algorithms will step in and sell into the strength. They will use the liquidity of the rally to exit their position. This puts a lid on the market. It suppresses gains and exacerbates losses. It turns the stock market into a grinding machine that chews up capital. We are entering a period of distribution. The smart money in Japan is distributing their shares to the retail investors in the United States who are buying the dip. Retail investors must be careful not to provide the exit liquidity for these massive institutional shifts. But there's another layer to this repatriation that makes it even more dangerous. It involves the currency markets. When a Japanese fund sells a US stock, they receive US dollars, but they need yen to pay their pensioners in Osaka. So they sell the dollar and buy the yen. This drives the value of the dollar down and the value of the yen up. Now you might think, who cares about the yen? You should care, because the weak yen was the fuel for the global carry trade. For years, hedge funds borrowed yen at 0% interest, converted it to dollars, and bought US stocks. It was free money. But as the yen strengthens, driven by this repatriation flows, the trade blows up. The hedge funds have to pay back the yen loans. To do that, they have to sell the US stocks they bought with the borrowed money. This creates a feedback loop from hell. Japan sells stocks, yen goes up, hedge funds blow up, hedge funds sell more stocks, market crashes further. It is a self-reinforcing cycle of liquidation. And once it starts, it is very, very hard to stop. The $500 billion is just the tip of the iceberg. That is just the Japanese institutional selling. It does not account for the trillions of dollars in global leverage that is tied to the stability of the Japanese bond market. This is why the analyst in our report warned, this won't remain a local issue. It will drag the global financial system with it. We are watching the unwinding of the biggest financial bubble in human history. The bubble wasn't in stocks. It wasn't in housing. The bubble was in cheap money. And the source of that cheap money was Japan. Now the source is drying up. The tap is being turned off. For the investor in the United States, this presents a unique danger. You are used to buy and hold. You are used to buying the dip. That strategy worked for 15 years because the global liquidity tide was rising, but now the tide is going out. If you buy the dip while a $500 billion whale is selling the rip, you are going to get crushed. This is why we are seeing such a rotation into commodities. Why would you hold a US tech stock that is being dumped by the world's largest pension fund when you can hold silver, which is being hoarded by the world's largest industrial powers? The flow of capital is telling you the story. Capital is leaving financial assets because the financial system is deleveraging. Capital is entering hard assets because they have no counterparty risk. If Japan sells a US Treasury bond, the bond price falls. If Japan sells an Apple share, the share price falls. But Japan is not selling silver. In fact, Japanese industry needs silver just as much as anyone else. This repatriation event is the catalyst for the Great Rotation. It is the force that pushes money out of the paper economy and into the real economy. We have to understand that this is an involuntary event. The Japanese central bankers do not want to crash the US stock market. The United States is their ally. They rely on the US for defense, but they have no choice. The math has cornered them. Their debt is too high. Their yields are rising too fast. They have to sacrifice their foreign holdings to save their domestic system. It is an act of economic triage. They are cutting off the arm to save the body. The arm is the US stock market. The body is the Japanese bond market. And you, the American investor, are sitting right on the arm that is about to be severed. This $500 billion selling program is a sword of Damocles hanging over Wall Street. It hasn't fallen yet. It is descending slowly. This week, we might see the first tranche of selling. Maybe $10 billion here, $20 billion there. It will look like normal volatility, but it is persistent. It is relentless. The bid underneath the market is disappearing. When the largest buyer becomes the largest seller, the price has only one way to go. In the next part of this deep dive, we are going to look at the Fed's nightmare. If Japan stops buying US treasuries, or worse, if they start dumping their $1 trillion stockpile of US debt, what happens to US interest rates? They spike. And if US rates spike, the US economy crashes. So the Federal Reserve has to step in. They have to replace Japan. They have to print the money to buy the bonds that Japan is selling. This is the ultimate inflationary trigger. We are going to explain why the Japanese crisis guarantees a massive wave of money printing in the United States, and why that is the rocket fuel that will send gold and silver into the stratosphere. The Japanese are selling, the Fed is buying, and the dollar is caught in the middle. We have watched the yields spike in Tokyo. We have analyzed the massive liquidation of stocks that is about to hit New York. But now we must turn our attention to the elephant in the room, the asset class that holds the entire global financial system together, the United States Treasury bond. For 40 years, the U.S. Treasury market has been the bedrock of the global economy. It was considered the risk-free asset. If you wanted safety, you bought U.S. debt. And the biggest buyer of that debt, the most loyal customer the United States Treasury ever had, was Japan. Japan holds over $1 trillion of U.S. government bonds. They are the largest foreign creditor to the United States. They financed our deficits. They financed our wars. They financed our stimulus checks. But today, that relationship is ending. With Japanese yields soaring to 4% at home, the Japanese institutions have no mathematical reason to hold U.S. debt. Why would they take the currency risk of the dollar? Why would they accept the volatility of the U.S. market when they can find better returns at home? They wouldn't. So they are going to sell, and they are not just going to sell a little bit. They're likely to sell hundreds of billions of dollars worth of treasuries to repatriate their capital. This creates the Fed's nightmare. To understand why this is a nightmare, you have to look at the United States' own balance sheet. We have over $38 trillion in national debt. We are running a deficit of $2 trillion a year. We need to sell billions of dollars of new debt every single day just to keep the lights on in Washington. In a normal market, when you issue debt, you need a buyer. For decades, that buyer was the foreign central bank. China bought, Russia bought, Saudi Arabia bought, Japan bought. But look at the roster today. Russia has sold everything. They are out. China is actively selling to buy gold and copper. They are out. Saudi Arabia is moving away from the petrodollar. They are out. Japan was the last man standing. Japan was the backstop. If Japan steps away from the table, or worse, if they start dumping their existing portfolio into the market, who is left to buy? There is no one. When there are more sellers of bonds than buyers, the price of the bond crashes. And when the price of the bond crashes, the interest rate, the yield, spikes. If Japan dumps its treasuries, we could see the U.S. 10-year yield spike to 5%, 6%, maybe even 7% overnight. This is the financial heart attack. If the 10-year yield hits 6%, the U.S. economy stops functioning. Mortgage rates would go to 10%. The housing market would freeze. Auto loans would go to 12%. The car industry would collapse. Corporate debt would become unserviceable. Massive bankruptcies would follow. But the most dangerous consequence is for the U.S. government itself. At current rates, the interest on the national debt is already over $1 trillion a year. It costs more to pay the interest on our credit card than we spend on our military. If rates double because Japan walks away, the interest payments would jump to $2 trillion. The United States would be mathematically insolvent. We would have to cut Social Security, cut Medicare, and cut the defense budget just to pay the interest to the bondholders. No politician in Washington will allow that to happen. No president will stand at the podium and say, "We are defaulting on your pension to pay the bond market." So, what is the solution? What happens when the buyer of last resort, Japan, leaves the building? A new buyer of last resort must be created. And there is only one entity with the power to do it, the Federal Reserve. This is the trap. The Federal Reserve knows that if Japan sells, they have to buy. They cannot let the yield spike. They cannot let the auction fail. So they will restart the printing press. They will announce a new program. They won't call it quantitative easing because that sounds inflationary. They will call it market stabilization or liquidity support or yield curve control. But the name doesn't matter. The mechanics are the same. The Federal Reserve will create trillions of new dollars out of thin air. They will use those dollars to buy the U.S. Treasury bonds that Japan is selling. They will put those bonds on their balance sheet and bury them. This is called debt monetization. It is the final stage of a dying currency. It is the moment when the government stops borrowing money from the world and starts borrowing money from its own printer. It is exactly what happened in Weimar Germany. It is exactly what happened in Zimbabwe. When you monetize the debt, you solve the liquidity crisis, but you create a currency crisis. You save the bond market, but you kill the dollar. This is why the Japan event is the ultimate rocket fuel for silver and gold. The smart money sees this coming. They see that the Fed is cornered. They know that the Fed has to choose between a depression, letting rates rise, or hyperinflation, printing the money. And they know that in an election cycle, in a debt-based system, the central bank always chooses inflation. They always choose to print. When the Fed prints $3 trillion to buy Japan's bonds, where does that money go? It goes into the system. It dilutes every dollar in your savings account. It destroys your purchasing power. This is why silver is hitting $94. Investors are not buying silver because they like the metal. They are buying silver because they are fleeing the dollar. They are prepositioning for the monetization event. They know that when the Fed announces the new printing program, the price of hard assets will gap up overnight. Gold will go to $5,000. If the dollar continues to devalue, some analysts believe triple-digit silver is not just a possibility, but a mathematical inevitability based on the shrinking value of the currency. The Japanese crisis is the trigger. It forces the Fed's hand. It removes the illusion that there is organic demand for U.S. debt. It exposes the fragile nature of a system built entirely on ever-increasing debt. The government knows the dollar is vulnerable. That is why they are trying to secure physical assets. They know that in a world where paper currencies are being debased to keep the bond market alive, the only real power lies in commodities, energy, food, metals. That is why Trump signed the Section 232 order. He is preparing for the post-dollar world. He is preparing for a world where you can't print your way to prosperity. You have to dig it out of the ground. The Fed's nightmare is the stacker's dream. While the central bankers panic, while they hold emergency meetings to figure out how to absorb the Japanese selling, the silver holder sits quietly. You hold the insurance policy against their incompetence. You hold the asset that cannot be printed, cannot be debased, and has no counterparty risk. When the Fed turns on the printer to buy the Japanese bonds, they are effectively transferring wealth from the dollar holder to the silver holder. This is the mechanism of the wealth transfer. It isn't magic, it is accounting. Japan sells debt. The Fed prints dollars. The dollar falls, silver rises. It is a mechanical inevitability. So, as we watch the yields in Japan tick higher, 2.3%, 2.4%, do not look at it as a foreign news story. Look at it as the countdown clock for the US dollar. Every basis point rise in Tokyo brings us one step closer to the restart of quantitative easing in Washington. And every dollar printed in Washington brings us one step closer to triple-digit silver. In the final part of this deep dive, we're going to look at the strategy. We have analyzed the crash in stocks. We have analyzed the bond market trap. Now, we need to tell you exactly what to do. We are going to discuss the safe havens. Stocks are dangerous. Bonds are lethal. Cash is trash. So where do you hide? We will outline the portfolio of the great unwind. We will explain why hard assets are the only lifeboat in a sea of liquidity. And we will give you the final verdict on the timeline. We will explain why you need to be positioned now before the panic hits the general public. Before we dive in, I need to take a brief moment to address our community. We are boring currency. We are the original channel. We spend our days tracking bond yields, analyzing central bank policy, and connecting the dots so you don't have to. We have noticed a surge of copycat channels, same avatar as ours. They are stealing our scripts. They are reposting our content on Twitter and TikTok. They are trying to build an audience on our hard work. I want to be clear, we have only one channel. It is this one on YouTube. We do not have a Twitter account under a different name. We do not sell crypto on Telegram. We are not asking for your money on WhatsApp. The other people using this avatar are not affiliated with us. We do not take responsibility for their info. We provide this video with a lot of research and only verified info because we respect your time. So if you appreciate the deep dives, please help us protect this community. Make sure to share this video and then head down to the comments section right now and type "Staying with the original." Let the algorithm know you're here for the real analysis. We read every single comment, and we truly appreciate you. Now, back to the Japanese crisis. The Japanese anchor has snapped, the ship is drifting, and the storm is coming. We have analyzed the tectonic shift in Japan, we have quantified the $500 billion selling program, and we have exposed the Federal Reserve's inevitable currency debasement. But now, we need to talk about how this crash is going to happen. Because if you are expecting a single Black Monday where the market drops 20% in a day, you are preparing for the wrong war. The data we received from our insider source contained a very specific, very chilling warning. It said, they won't dump it all at once, that would be too catastrophic. Instead, they will slowly dump it over the next few months. This is the slow grind. And for the retail investor, it is infinitely more dangerous than a flash crash. In a flash crash, everyone panics at once. The price washes out. The weak hands sell. And then the market recovers. It is over quickly. But in a slow grind, the market tricks you. It drops 2%, then rallies 1%. It drops another 2%, then rallies 1%. It lures you in. It makes you think that this time is the bottom. It convinces you to buy the dip, but there is no bottom. Because the selling pressure isn't emotional, it is structural. Japan is not selling because they are scared. They are selling because they have a mandate to repatriate capital every single day to cover their domestic yield curve control costs. They are a price-insensitive seller. This means that every time you buy the dip in the S&P 500, you're providing exit liquidity for a Japanese pension fund. You're taking the bag from the smart money and holding it while it loses value. This kills the buy the dip strategy that has worked for 15 years. That strategy only works when the central banks are injecting liquidity, but right now, the global liquidity tide is going out. The data explicitly warns that this sell-off includes stocks, crypto, money market funds, literally anything. Let's break down these danger zones. First, tech stocks. Japan owns hundreds of billions of dollars in US technology names. Apple, Microsoft, Nvidia. These stocks have been the ATM for the global financial system. When you need cash, you sell what is liquid. You sell what has a profit. If Japan is selling $50 billion of tech stocks a month, that creates a permanent overhead supply. It puts a lid on the market. It means that the AI boom we discussed in the silver video is colliding with a liquidity bust in the equity market. The companies might be doing well, but their stock prices will be crushed by the flow of funds. Second, crypto. I know many of you hold Bitcoin, and in the long run, Bitcoin, like gold and silver, is a hedge against debasement. But in the short term, crypto behaves like a risk asset. It is correlated to liquidity. When Japan drains liquidity, speculative assets get hit first. The data warns that rising yields are forcing investors to dump positions worldwide. If a hedge fund blows up because of the yen carry trade, they sell their Bitcoin to cover the margin call. We could see a scenario where silver rises, safe haven, while Bitcoin falls, liquidity drain, in the initial phase of this crisis. Do not be confused by this divergence. It is simply the mechanics of leverage unwinding. Third, money market funds. This is the one that should scare you. Money market funds are supposed to be cash equivalents. They are supposed to be safe, but they hold short-term commercial paper and government debt. If the bond market breaks, if yields spike uncontrollably because Japan is selling treasuries, the assets inside these funds lose value. We could see a break-the-buck scenario similar to 2008. If you have your dry powder sitting in a money market fund thinking it is safe, you need to understand that you are unsecured creditor to a system that is under attack. The analyst in the report states, "The world is entering a rate environment no one alive has traded before." This is the key. No trader working on Wall Street today was active in 1980. They have only ever known falling rates. They have only ever known the Fed put. They do not know how to trade a sovereign debt crisis originating from a G7 nation. They will try to buy the dip because that is what their algorithm tells them to do. And they will get run over by the Japanese steamroller. This slow grind is predicted to last 12 to 24 months. Imagine 2 years of a bear market, 2 years of lower highs and lower lows, 2 years of your retirement account bleeding out slowly. This is the wealth destruction phase. But remember, wealth is never truly destroyed. It is transferred. While the paper assets, stocks, bonds, crypto tokens, are grinding lower, the capital that is fleeing those markets has to go somewhere. It cannot go to cash because inflation is eating the cash. It cannot go to bonds because rates are rising. It has to go to real things. This is why the Japan event is the ultimate confirmation of the commodity supercycle. When Japan sells paper assets, they are effectively saying, "We do not trust the future cash flows of the Western economy. We want our money back." And when they get that money back, what will they do with it? They will buy commodities. They need oil. They need copper. They need food. Japan is an island nation with almost no natural resources. They are the most vulnerable nation on earth to a commodity shortage. So, as they sell U.S. stocks, they will likely rotate that capital into securing physical resources. This creates a seesaw effect. On one side, paper assets, stocks, bonds go down. On the other side, hard assets, silver, gold, oil go up. The slow grind in the stock market becomes the slow melt up in the commodity market. You have to decide which side of the seesaw you want to sit on. If you stay in the danger zones, the overvalued tech stocks, the corporate bonds, the unbacked crypto, you are fighting the tide. You are betting that Japan is bluffing. But if you move to the safety zone, the physical metals, the energy producers, the arable land, you are swimming with the current. We will continue to monitor these liquidity levels closely. If the data suggests a total market breakdown, we will be here to break down the move. But by the time the mainstream media notices, the window to act may already be closing. We are in the twilight period. The sun is setting on the era of cheap money. The shadows are getting longer. The yields are spiking. The slow grind has begun. The first few percentage points of the drop will feel like a correction. The next few will feel like a concern. The final drop will feel like a panic. But by the time the panic hits, the exit door will be jammed. You need to exit the burning theater while the movie is still playing. You need to get out of the paper trap before the crowd realizes that the Japanese fire marshal has locked the doors. In the final part of this deep dive, we are going to look at the safe havens. We are going to give you the specific strategy for surviving the Japan event. We will explain why silver is the unique beneficiary of this specific type of crisis. We will talk about the portfolio of the future. What does it look like when bonds yield 5% but inflation is 10%? And we will give you the final verdict on the timing. Why you must act now before the slow grind turns into the fast crash. The Widowmaker has snapped. The margin call has been issued. Japan is going home. Are you coming with them to the safety of hard assets, or are you staying behind in the paper casino? We have arrived at the conclusion. If you have been with me through this geopolitical autopsy, you now understand the full magnitude of the event that started in Tokyo this morning. You understand that the spike in Japanese yields is not a glitch. It is the end of a 30-year economic cycle. You understand that the great repatriation of $500 billion is about to put a ceiling on the U.S. stock market. And you understand that the Federal Reserve is about to be forced into the greatest money printing campaign in history to absorb the debt that Japan is dumping. The evidence is overwhelming. The Widowmaker trade has finally snapped. The global margin call has been issued. So the only question left to answer is, where do you hide? For the last 40 years, the answer was simple. You bought the 60-40 portfolio. You put 60% of your money in stocks and 40% in bonds. The theory was that when stocks went down, bonds went up. They were the hedge. They were the safety net. But the Japan event burns that safety net to ash. Because Japan is selling both stocks and bonds, both asset classes are falling at the same time. The correlation has gone to 1. If you hold a 60-40 portfolio today, you're not diversified. You're doubly exposed to the liquidation of the Japanese balance sheet. You are holding 2 burning matches and hoping one of them puts the other out. This is the investment trap of the 21st century. So what is the portfolio of the future? What is the anti-Japan trade? It is a portfolio built for a world where sovereign debt is a liability, not an asset. It is a portfolio built for financial repression and currency debasement. It is the hard asset portfolio. And at the very top of that list sits silver. We have talked about silver's industrial fundamentals, the solar panels, the AI chips, the missiles. But the Japan event adds a monetary premium to silver that is impossible to ignore. When the Federal Reserve prints $3 trillion to buy the bonds that Japan is selling, they are diluting the currency. They are making every dollar in your pocket worth less. In that environment, you do not want to own promises to pay, which is what a bond is. You want to own payment itself. Gold and silver are the only financial assets that are not someone else's liability. If Japan goes bankrupt, your gold does not care. If the U.S. Treasury defaults on its interest payments, your silver does not care. They are sovereign in their own right. And while gold is the shield, it protects your wealth, silver is the sword. Silver is the high beta play on the collapse of the fiat system. Because the market is so small and the industrial demand is so inelastic, the money printing from the Fed acts like rocket fuel for the silver price. When the Fed monetizes the debt, gold might go up 10%. Silver will go up 30%. We saw this in the 1970s. We saw this in 2011. And we are seeing it again now, with silver hitting $94 while the stock market shakes. So here's the strategy for the great unwind. Step 1, identifying the risk-heavy sectors. We are seeing a massive rotation away from long-duration bonds and high-valuation tech stocks as the cost of capital rises. By understanding these flows now, you are positioning yourself ahead of the institutional shift. Step 2, accumulate real things. This means precious metals. It means energy producers. It means agricultural land. Why physical? Because, as we discussed in our previous reports, the paper markets are breaking. The force majeure risk is high. When the Japanese crisis hits full speed, the banking system will freeze. Counterparty risk will skyrocket. You do not want to be the creditor of a bank that is insolvent because of a yen margin call. You want the asset in your hand. Step 3, patience. The data warned us that this will be a slow grind. It won't happen overnight. It will be a 12 to 24-month process of liquidation. There will be days when the market rallies. There will be days when the media tells you Japan is fixed. Do not believe them. The math is terminal. A country with 260% debt cannot survive 4% interest rates. It is a mathematical impossibility. The liquidation will continue until the debt is inflated away. This brings us to the final verdict on the timing. The analyst in the report concluded that we are approaching a maximum de-risking event, and we will be here to provide updates. As the data shifts, I'm telling you that time is approaching fast. The spike in Japanese yields is the signal that the end game has begun. We are no longer in the accumulation phase of the credit cycle. We are in the destruction phase. The wealth that was built on cheap money and zero interest rates is about to be vaporized. But the wealth that is built on atoms, on gold, on silver, on resources, will be preserved. This is the greatest wealth transfer in history. It is transferring from the paper world of the West to the physical world. Japan is the catalyst, the Fed is the accelerant, and silver is the vehicle. You have the map, you have the data, you have the warning. Do not let the slow grind lull you to sleep. The water is boiling and the frogs are starting to float. Thank you for being part of the boring currency community. We know this information is heavy. We know it contradicts everything the financial advisors tell you, but that is why we are here. Leave a comment saying, staying with the original, to let the algorithm know where the real research lives. The Japan event is the domino that knocks down the rest of the world. The yield curve has snapped, the bond market is broken, and the safe harbor is made of metal. Stay safe and get ready for the repricing of everything. We will see you on the other side. Subscribe.